Good evening, students. I hope you have revised everything. Hello. Yeah. I hope you have revised everything by now. I had asked you to quickly revise everything. I hope you have done that. Okay. Now, what I'm going to do is we are going to start, or we are going to proceed rather ahead. So, till what we had finished is consolidation of plans within the scheme of the mutual fund. Now, few more instruments, as I told you even last time, we are going to quickly cover that. Then we are going to get into the computation aspect. And finally, we would be getting into the restructuring part, right? So, few instruments, few things here and there, and then we will finally proceed towards the main part of it, which is the reorganization. In case we are not able to finish off the chapter today, then what I would be suggesting is we would do the balance part of it, which would remain as more so section 54 onwards, that we would be doing in the or before starting the income from other sources topic. Clear? Okay. So let's quickly start. Today we have lot to cover. Okay. The next instrument which we are going to cover is about the rights issue. Rights instrument. So again, under section 49, there are the costs which are mentioned over there. Also, the cost of acquisition is also mentioned under section 55. So there are two sections for this. Cost which are mentioned under section 49, and then we have the cost mentioned under section 55. There are special costs which are mentioned under section 55, right? So this is for the rights issue what we are going to talk about, right? So in case of the right shares, right? So in case where the assessee is acquiring any rights share, so in that particular case, a right to subscribe to shares. So what will be the cost of acquisition under section 55? Under section 55(2), it is the actual amount paid. It is the actual amount paid. Clear? So in case the assessee becomes entitled to subscribe to any right share, so the actual amount paid for acquiring the right share. The Act does not use the term rights, it uses the term financial asset. So it uses the term that in case where by virtue of holding a share, right, by virtue of holding a share, the assessee becomes entitled to subscribe to any financial asset or is allotted any additional financial asset without any payment, then in relation to that as financial asset, the cost of acquisition means the cost or the amount actually paid for acquiring the original financial asset. For the rights issue, or you can write it in the bracket, financial asset, because the Act uses the term in that manner. Okay. In relation to right to renounce the shares. So if you have a right to renounce the shares, so when you're renouncing the shares, when you're renouncing the entitlement to the financial asset, right to renounce the entitlement to share. What is the cost? So you have also got the right to subscribe to that financial asset, right? If you're subscribing, the amount actually paid for that acquiring the financial asset. In case you decide to renounce the financial asset or the rights issue, then what is the cost? You have not exercised anything, right? So the cost will be nil. Cost of acquisition will be nil, right? Then a person who is purchasing the rights renounced. So shares acquired by purchasing rights renounced or financial asset renounced. So in case you are subscribing in relation to financial asset to which this subscription is made, so then it is the amount actually acquired. In relation to the financial asset, which is where the entitlement is there and which you're renouncing in favor of any other person, then the cost of acquisition is nil. And in relation to the financial asset, where I am purchasing that particular rights issue, where by purchasing the rights renounced. So rights issue or the shares purchased by any person in whose favor the rights to subscribe has been renounced. So in that particular case, the amount of purchase price plus amount of purchase price for purchasing rights share plus the cost of shares. So you will pay the shares cost to the company plus you will pay to the person who is renouncing it in your favor. Are we clear? In case of bonus shares, again here the Act does not use the term bonus. It just says that in relation to a financial asset which is allotted to me without any payment, because I'm holding the shares of that company, then in that case the cost of acquisition will be, if allotted before 1/4/2001, then fair market value. After 1/4/2001, nil. Clear? Then goodwill of business, or profession, goodwill of business or profession or trademark or brand name or right to manufacture, produce, process, or right to carry on any business, or profession, tenancy rights, stage carriage permits, LUMARs, then in that case it shall be, in case these are acquired, then if these assets are acquired from the previous owner, then it is the purchase price, right? In case if these assets acquired, or you can just write it down, acquired through a gift or will, acquired through gift, will, or any other modes which are referred under section 49(1), right? Which are referred under section 49(1). So 49(1), if you remember, I told you that under 49(1), if there is any gift made, or there is a will, or there is succession, inheritance, or partition of the HUF, distribution of assets by the HUF, then in that particular case, it is considered as an exempt transfer, and the cost of acquisition is the cost to the previous owner, or partition of HUF or succession, then cost to the previous owner under section 49(1). Other cases, it is considered as nil. Clear? It is considered as nil. Are we clear? Any doubt? Any questions? Any doubt? So we have covered all the instruments, as well as we have covered the intangibles also, right? So we have covered in the last class about the conversion of debentures into the equity shares. We have also covered the conversion of preference into equity. We have covered the redemption of the preference shares. Then we had seen about the redemption of the other shares, right? So if you remember, we have done all the cases in the earlier class on the rupee denominated bonds, sovereign gold bonds. Then we have seen redemption of bonds, reduction of share capital, then consolidation of plans, rights issue, and bonus shares we did today, as well as the intangibles. Are we clear? So goodwill of a business or profession, it is usually nil. If it is acquired, then the cost, and if it is acquired from the previous owner under any of these mode, then in that particular case, it will be cost to the previous owner. Clear? Also, if you remember, goodwill of a business or profession now is not eligible for the purposes of the depreciation. Clear? Okay. So let's proceed further then. Okay. The next thing what we are going to now cover is the employee stock options. ESOPs. This is another instrument which we have to cover now. So tax implications on ESOPs. Tax implications on ESOPs. So if you remember, we have not dealt in the lectures, but you know about it, that under the head salaries, there is the provision wherein if the ESOPs are granted to the employees, it is considered as the perquisite, right? So when ESOPs are exercised, income from salaries, this is considered as perquisite under section 17(2)(6). What is the taxable amount? Exercise price minus the fair market value. So under section 17 of the Income Tax Act, first this is considered as the perquisite, and the exercise price minus the fair market value when it is exercised is considered the perquisite under section 17. Clear? Under section 17, this will be taxable. So FMV is computed as per the rules which are there for the purposes of that particular section. Are we clear? Clear? Any doubt? So how it is computed is, I'll just quickly give you a idea about it, how the taxability happens under the head salary. So under the head salary, as I said, the 17(2)(6) provides that ESOPs which are issued to the employees, right? The value of any specified security or a sweat equity shares allotted to the assessee by the employer, that is considered as perquisite. And what is the amount which is considered? The FMV, excise price minus the FMV. And FMV which is there is provided under the rules to that particular section. So if you go to the salaries chapter, you will understand how the FMV is computed under that particular section. Are we clear? Clear? Any doubt? Any question? Yes. Then under the head capital gain. Yes, we are coming over that. Under the head capital gain, how particularly this computation results under the head capital gain? When you are selling the ESOPs, then there is the taxability under the head capital gain. So when ESOPs are sold, then capital gain. And what is the amount? Capital gain, full value of consideration will be sale consideration, right? Cost of acquisition will be this FMV. FMV as on date of exercise. Period of holding is till exercise date. From exercise date till date of sale. So it is not from the vesting date, but from the exercise date. Are we clear? And how do you compute the FMV over here? So valuation is given under rule 3(8) for the valuation. Rule 3(8) talks about the valuation. And what is the valuation principle over there? So rule 3(8) says that in case the ESOPs are issued, the fair market value of the equity share on the date on which option is exercised by the employee. Remember, it is the date of exercise and not the vesting date. If the share is listed on a recognized stock exchange, if the share is listed on a recognized stock exchange, then the fair market value shall be the average of opening and closing price. Right? Average of opening and closing price. If shares are listed on more than one recognized stock exchange, for example, on NSE as well as on BSE, then in that particular case, the fair market will be value will be the average of opening and closing price on the share on the recognized stock exchange which records the highest volume of trading. So, if listed on more than one recognized stock exchange, then average of opening and closing price on the recognized stock exchange which records highest volume. And if there is no trading for the share on a recognized stock exchange on the date of exercising of the option, then if no trading on recognized stock exchange, then the closing price of the share on the recognized stock exchange on a date closest to the date of the exercising option. Clear? So closing price on date closest to the date of exercise or and immediately preceding such date. Clear? Or the closing price of the share which records the highest volume of the trading in such share on the recognized stock exchange which records the highest volume of trading in such share if the closing price as on the date closest to the date of the exercising of the option and immediately preceding such date is recorded on more than one stock exchange, right? So if it is on more than one stock exchange, then you will take the value, the closing price on the stock exchange which has the highest volume. Clear? If share not listed, if it's an unlisted share or share is not listed on a recognized stock exchange, then in that particular case, it will be the fair market value will be as determined by merchant banker. Are we clear? Any doubt? Any doubt? What is this date of valuation? Date of valuation is the date of exercising the option or any date earlier than the date of the exercising the option, which is not beyond the 180 days. Which is not beyond the 180 days. Clear? So within that date only, you have to consider the value of that particular stock, right? Because it says as on the specified date. So what is the specified date? In case if it's an unlisted share, it has to be on the value determined by merchant banker on the specified date. So the specified date is the date of exercising the option or not one beyond more than 180 days. Clear? Any doubt? Okay. Okay, one more thing. If there is a specified security, so the fair market value of any specified security, which is not equity share in a company, right? So what is a specified security? Specified securities and means the ESOPs which are allotted by the startups, right? Where the shares or securities are allotted by the eligible startup which has the exemption under section 80 ISC. So shares or securities or shares allotted by startup under section 80 ISC. Clear? So the tax on the perquisite of the sweat equity shares or is required to be paid in the year of exercising of the option, correct? But for the startups, the perquisite is taxable in the year in the previous year after the expiry of 48 months from the end of a relevant assessment year in which sale of shares or securities are made by assessee, in which assessee ceases to be employee, whichever is earlier. So generally, see what happens for the, if you see the perquisite year is considered as the income of the previous year in which you exercise the option. So in which assessee exercises the option. Taxability arises in that particular year, right? So it is considered as perquisite of the year in which the assessee exercises the option, because you see, you reduce exercise price minus the fair market value. But for the startups, see, when you're exercising the option, at that point in time, you are required to pay the money, right? So for the startups, this was causing hardship, and therefore the shares or securities which are allotted by startup, the ESOPs which are issued by the startup, the perquisite is taxable in the previous year after the expiry of 48 months from the end of the relevant assessment year, or in which sale of securities are made by the assessee, so in which he realizes also the capital gain, or the year in which he ceases to be the employee. So you can just write it down. ESOPs allotted by the startup. Clear? Yes. Now I'll take up some doubt. If business was acquired prior to 1/4/2001, is there difference on the treatment of intangibles under section 55? Yes. If you are acquiring it prior to 2001, then in that case also it is considered to be nil usually, but you can take the fair market value. You can take the fair market value, because if you go to section 55, 55 allows you to take the fair market value as on 1/4/2001. So you can still opt for the fair market value in that particular case. But since this has always been considered as nil, this is a specific case where it has been specifically held that then it shall be nil. So therefore, I would suggest that it should be the nil only. Right? Any other question? Because this is a specific case where we have the nil as the cost of acquisition. So specific provision will prevail over the general one. So if you see in relation to capital asset, which becomes the property before 1/4/2001, the cost of acquisition is fair market value at the option of the assessee. So it is at the option of the assessee what he wants to choose. But for goodwill and all, the specific provision is that it has to be nil. Is indexation allowed for Arvind? You're saying for this
recording stopped.
Hello?
Recording in progress.
Yeah. Arvind, you're asking about indexation allowed for the ESOPs? Vinay, I already answered for the business acquired before 1/4/2001. The indexation for the ESOPs will remain the same. What we have it for the shares. If it is unlisted, you can allow it. listed, then it is as per 10%. Okay. Then next instrument, zero coupon bond. Zero coupon bond. So for zero coupon bond, again, if you remember, I had told you what is the period of holding for the zero coupon bond. Period of holding is considered as 12 months. So if it is greater than 12 months, it is long term. If it is less than 12 months, it is short term. Maturity and redemption of zero coupon bond is expressly considered transfer under section 247, if you remember the definition of transfer. Taxation will be 20% with indexation or 10% without indexation. Are we clear? This is for the zero coupon bond. Next is, so we have covered all the instruments here. Corporatization and demutualization of stock exchange. Now, what is this? This is a small provision which I will just quickly cover with you. So what happens? Let's say there is a broker. So earlier there was, say, a firm, the association of person was existing, right? Now, what they have done is they have corporatized the stock exchange. So earlier, the broker was part of the membership of the AOP. Now that AOP is corporatized and converted into a corporate form, right? So let's say the broker was there, which had the capital. Sorry. Broker was there, right? Providing capital contribution to, let's say, AOP stock exchange. So he had the ownership plus membership rights. Now, the AOP gets converted to company due to corporatization and demutualization, right? So what happens in that particular case? There is transfer of membership rights in AOP by the broker, and in return he gets the trading rights or the shares of the stock exchange, right? So now this particular transaction is not regarded as transfer under section 47. So this is an exempt transfer. But when, let's say, for example, the trading rights are sold, then in that particular case, your FVC will be your amount received. Cost of acquisition will be considered as nil. Because for trading rights, you have not paid any cost of acquisition. Period of holding will be again clubbed. So period of holding from the broker became member in AOP. And indexation also will be available for that entire period. Clear? If it is sale of shares, whatever shares I have now in the stock exchange, which is a corporate exchange now. So if I sell those shares, your FVC will be your amount received, right? Cost of acquisition will be my capital contribution to AOP. Period of holding again will be same, which will include the period when I was member in the AOP, and same with the indexation. Are we clear? Any doubt? Okay. These are small topics. I'm just quickly wrapping up with them. Then is reverse mortgage. Now, what is reverse mortgage scheme? Let's try and understand. So let's say Mr. A is there, who is a senior citizen. Right? There is Mr. A, who is a senior citizen. He enters into the scheme where he mortgages the house with the bank, right? With the consideration that he gets monthly or lump sum pension. So in return of the lump sum or monthly pension, he mortgages the house. Generally, it happens, right? They do not have any source of income. So what they do is they have house, they will mortgage it with the bank. This is a scheme with the bank, and they will get the monthly or lump sum pension, right? So in that particular case, this is considered as exempt under section 1043. So the pension is considered as exempt under section 1043. Even the mortgage is not taxable transfer under section 47. Right? Now let's say Mr. A died. So, son of Mr. A repaid the loan and sold the house. So in order to sell the house, he had to free the house from all the encumbrances. So the full value of consideration will be my sale consideration. Cost of acquisition will be what? For the son of Mr. A, let's say Mr. B. What will be the cost of acquisition for the son? What will be the cost of acquisition for the son? Very quickly, my question is to you. What is the cost? Quickly. Hello, everybody. Are you with me? Everyone? Yes. What is the cost? Is it a difficult question? Quickly tell me the answers. We do not have time. I'm waiting for your answers. Are you with me? Yes or no? So give me the answers. Hemant, this is for group 2 and not for group 1. You are in the wrong class then. Are you with me? Yes or no? I'm not getting any answers. Fast. What is the cost? What is the cost? No answers? Okay. I'm assuming that all of you are sleeping then. The cost of acquisition is the cost to the previous owner because this is received on the death. So it is inherited by Mr. A. The house is inherited by Mr. A under section 49(1) plus the loan amount we paid. So the Supreme Court in the case of RM Arunachalam, RM Arunachalam held that in case of inheritance of encumbered property, what a person inherit is the mortgager's right in the property. In order to clear the title, of such encumbered property, if the inheritor repays the debt and thereby acquires the mortgagee's interest also, mortgagee's right in the property also, the amount repaid by the inheritor will be considered towards the cost of addition. So, if Mr. A was inheriting, Mr. B was inheriting the property from Mr. A, he only acquired the interest of the mortgager. So there was an encumbrance by the bank also, by the bank loan which was going on. In order to clear the title of that property, in order to clear off the encumbrance, in order to acquire the even bank's interest in the property, I had to clear the loan. So the cost paid towards the loan will also be considered as the cost of addition. Are we clear? So this is the RM Arunachalam case. Amount of loan repaid will also be considered as the cost. The indexation will be from when? At least this you can answer me. I'm not getting any answers today. Very bad. I think you have not revised it. Are you with me or not? Okay. So indexation will be from the date. Indexation will be from the date when the previous owner held the asset. The year from which? Year when the previous owner first held the asset. This is as per explanation 1 to section 242A, right? No. This is as per Bombay High Court ruling in Manjula Shah case. Now you remember this? Okay? Fine. Let's say let's twist this example, and let's say in case Mr. So son of Mr. A is here, I'm just writing it down, Mr. B. Let's say now Mr. B purchases the house in 2005, cost of acquisition 5 lakh for, through he borrows certain amount by mortgaging the house property. So mortgages house property for loan of rupees 2 lakh. Subsequently repays the loan and sells the house in 2010 for 20 lakhs. Now, will he get the cost of addition of rupees 2 lakhs? Will the repayment the assessee basically repaid the loan and took the benefit of the repayment of loan by following the judgment of RM Arunachalam. He said in RM Arunachalam, Supreme Court has allowed the repayment of loan for clearing the encumbrance as the cost of acquisition, and therefore even I will get held that in this situation, the cost of acquisition will not have the repayment of loan of rupees 2 lakh. Why? Because where the property is mortgaged not by the previous owner, but by the assessee himself. In RM Arunachalam, the assessee himself had not mortgaged, but the previous owner had mortgaged and the assessee cleared off that mortgage. Here, if the assessee himself is mortgaging, then in that case, then the amount paid to discharge the mortgage could not be treated as cost of acquisition. So this is not comparable to RM Arunachalam. Clear? Any doubts? Yes or no? At least reply to me in the chat box so that I know you are with me. I'm not getting any responses. Are you guys with me? Yes or no? Yes or no? Okay. Thanks, Miraju. So have you understood this? So then you should be answering this. Okay? Chalo. So then we are moving towards the next topic under the capital gain, which is reorganization. First, I'll cover that, and then I will finally cover the computation provision. Because first we'll cover the important aspect, and then we can, cover the next topic, which is the computation provision. That we'll quickly cover. Okay. So reorganization. In reorganization, we have several sections. First, we are starting with the section 47. We are starting with section 47, which is in the context of the transfer of a capital asset. Transfer of a capital asset by the holding company to the subsidiary company or vice versa. Clear? Okay. Let me just write it down here very quickly for you. Transfer of capital asset by the holding company to subsidiary company or vice versa. Okay. Yes, Jacob, clear. Okay. So transfer of the holding company or subsidiary company to the subsidiary company or vice versa. This is under section 47(4) and section 47(5). So transfer of a capital asset by the holding company to the subsidiary company is under 47(4), and vice versa, which is transfer by the subsidiary company to the holding company, is in the 47(5). Okay. So first is holding company transferring the capital asset to the subsidiary company. This is exempt under section 47(4). Okay, this is exempt under 47(4). Similarly, subsidiary company transferring the capital asset to the holding company is not a taxable transfer. 47(5). Clear? Okay. Now, here there are conditions. And what are the conditions here? This is a conditional transfer exemption. What is the condition over here? So, primary condition. There are two conditions to this. What is the primary condition? The subsidiary company should be a wholly owned subsidiary. ESCO should be a wholly owned subsidiary. Clear? And recipient company should be Indian company. So both the conditions are to be satisfied. This is and conditions. Subsidiary company should always be a wholly owned subsidiary. Recipient company should be Indian company. So in this particular case, if you see, whether it is the HCO, this should be the Indian company. If it is subsidiary company getting the asset, then this should be the Indian company. Clear? Okay. What is the additional condition? Additional condition is subsidiary company shall not cease to be a wholly owned subsidiary. Subsidiary company should not cease to be the wholly owned subsidiary. Now, this additional condition is to be complied for a period of 8 years. This has to be complied for a period of 8 years. Second additional condition is the recipient company shall not convert capital asset into stock in trade. Again, this is the AND condition, meaning both conditions need to be complied with. Are we clear? So what are the two primary conditions? Subsidiary company should be a wholly owned subsidiary. Recipient company should be Indian company. Additional condition has to be complied for a period of 8 years. Subsidiary company shall not cease to be a wholly owned subsidiary. And recipient company shall not convert capital assets into stock in trade. Are we clear? Further, under income from other sources, we are going to learn with this concept, but let me just introduce it for you. So if the recipient receives any capital asset or any property for a consideration which is less than the fair market consideration, fair market value, or he receives without any consideration, and if the value of that exceeds 50,000. So if I'm receiving any capital asset without any consideration, without paying anything in return, or if I'm receiving the capital asset which is at the value which I'm paying for that is less than the fair market value, and that then the differential amount exceeds 50,000, then it is considered as the income of the recipient. It is considered as the income of the recipient. So that provision would have otherwise been applicable a year, but here there is exemption for that. So the exemption is 56(2)(10) will not be applicable if capital asset is received by the holding company from subsidiary company and vice versa, provided the recipient is the Indian company. Clear? So 56(2)(10) will be not applicable. Clear? Now, what if the additional conditions are violated? If the primary conditions are violated, you will not get the exemption only. That's very clear. If you are not a wholly owned subsidiary, you will not get an exemption. If you are not an Indian company, if the recipient is not Indian company, you will not get exemption. That is very clear. But what if the additional conditions are violated? If, let's say, the subsidiary company ceases to be a wholly owned subsidiary. Let's say, if violation of additional conditions. If, let's say, subsidiary company ceases to be a wholly owned subsidiary, then what happens in that particular case? Yes, Chekhov, both the conditions need to be complied for the period of 8 years. Both the conditions. So that is very, very clear. But now the question arises, what if the conditions are violated? Then what do we do? So in case the conditions are violated, the first condition which I told you is that the subsidiary should remain as the wholly owned subsidiary. So then in that case, 47A, section 47A will get triggered, and it says that the exemption will be withdrawn if the conditions are violated. The exemption will be withdrawn. So the exemption, what is the exemption which is there, which is given? The capital gains which was taxable was considered not taxable. So how will we compute the income over here? So revocation of 47.4 and 47.5. So your full value of consideration will be FMV on the date of transfer. Full value of consideration will be FMV on the date of the transfer. Since here my exemption which was granted to me, if I have not fulfilled the condition, will be withdrawn. And for that purpose, what will happen is my full value of consideration will be the fair market value. Clear? My fair market value. Then less indexed cost of acquisition or cost of acquisition, right? Long-term capital gain or long-term capital loss, whatever will be here. Clear? Now, when subsequent transfer of the capital asset by the subsidiary company. Now, capital asset which is there is subsequently transferred by the subsidiary company. Then in that case, full value of consideration will be taken up, whatever the sale consideration is, less cost of acquisition, your capital gain will be taken up. So here the cost of acquisition will not be the cost to the previous owner. If the conditions would not have been violated, then in that particular case, cost of acquisition to subsidiary or to the holding company would have been cost to the previous owner. Cost to the previous owner, right? So if the conditions are not violated, then the cost to the subsidiary or holding company will be the cost to the previous owner. If capital asset is transferred subsequently. Clear? Period of holding, as per explanation 1 to section 242A, it will be clubbed. So, clubbed of the previous owner also. Indexation is also available usually for the previous owner's period as well. Alright, this is as per Manjula Shah judgment. But if the conditions are violated, then the indexation, period of holding, and the cost will not be of that previous owner. Clear? So here, no clubbing of period of holding and cost of acquisition is not cost to the previous owner. Then what will be my cost? Cost will be this amount. The fair market value which is taxed over here. Clear? Now, next is if the subsidiary company or holding company, the recipient company, converts the capital asset into stock in trade. I will write it over here. Recipient company converts capital asset into stock in trade. Then also the condition is revoked. Sorry, the condition is violated. So exemption will be revoked. So again, full value of consideration is equal to the FMV on date of transfer. Cost of acquisition will be the cost or indexed cost of acquisition, long-term capital gain or long-term capital loss. Right? Now, subsequent transfer of capital asset by the subsidiary company or holding company whoever is the recipient, you can write it in the bracket, recipient company. Let me see who gives me the answer. How will the subsequent transfer be treated in the subsequent transfer for the holding and the subsidiary company? How will it be treated? Let me see who gives me the answer. What will be the answer? How will it be treated? No exemption. Okay, that too is done, right? We understood that there is going to be no exemption. The exemption is revoked. But how the subsequent sale will be treated? Okay, so nobody remembers this. As I said, you're not revising very clearly. So subsequent transfer by the subsidiary or holding company will attract what was this? Now at least you should be able to tell me, huh? No, Jacob. I've given you the answer. Now please elaborate this answer. Yes? What is this? 45-2? What is this 45-2? Guys, please answer. Look, first of all, I can't see you, so you have to answer to me to let me know that you are with me. Even if you don't know, say don't know, but at least tell me something. Yes, Jacob, you're correct. Conversion of capital asset into stock in trade. So in the hands of the recipient company, 45-2 will be triggered. Your full value of consideration is FMV on the date of conversion. Correct? Taxable in the previous year in which stock in trade is sold. Right? Less indexed cost of acquisition, long-term capital gain or long-term capital loss. Manjula Shah, not applicable over here. And no clubbing of period of holding. Clear? Your cost of acquisition will be into CII of year of conversion. Right? Divided by CII of year of transfer. Clear? So here, cost of acquisition will not be considered that of the previous owner. We will take the FMV only. This particular FMV on the date of transfer, not on the date of conversion. Right? Here, then there will be PGBP, which is selling price minus the cost price, which is FMV on the date of conversion. This cost of acquisition will be your cost, right? Are we clear? So is this understood? So in the hands of the recipient, it will be 45.2, which will get triggered. 45.2, which will get triggered, right? So in a case where the capital gain, which is arising from the transfer of a capital asset by the holding company or by the subsidiary company, is deemed to be the income chargeable under the head capital gain by virtue of 47A, the cost of acquisition in this particular case will not be cost to the previous owner, but the cost for which asset is actually acquired. So here, Manjula Shah will not be applicable, period of holding will not be applicable, and cost of acquisition will be the cost actually paid and not cost to the previous owner. Or let me write it over here. Clear? And the same logic goes with this as well. Clear? Any doubt? Okay. Okay. So we are done with 47.4 and 47.5. Now the next is the demerger. Next is the demerger. Now let's get on to the demerger. So what happens in demerger? Let's say there is a company ABC. Now I'm transferring the unit C, and this is becoming C Private Limited. A new company is getting formed. So this is the scheme of demerger. Right? This is the scheme of the demerger. So in the demerger, one of the unit is hived off and transferred to the new company. Right? So this becomes my demerged company, and this becomes my resulting company. Right? So here, first of all, there is a transfer happening by the ABC Private Limited to C Private Limited of Unit C. In return, C Private Limited will issue the shares to the shareholders of the demerged company. So what is happening is the demerged company is transferring the unit. In return, the resulting company will issue the shares to the demerged company, to the shareholders of the demerged company. So if that is the case, this particular transfer is considered as the exempt. So any transfer of a capital asset by the demerged company to the resulting company, if the resulting company is the Indian company, so this should be, the resulting company should be the Indian company. This is considered as exempt transfer under section 47, under section 47(6)(b). Right? Similarly, if you see, the shareholders are also getting the, so shareholders are also getting the shares in the resulting company, right? So any transfer or issue of shares by the resulting company to the shareholders of the demerged company, then in that particular case also it is considered as the exempt transfer. This is also exempt transfer under section 47(6)(d). Are we clear? Clear? Now, what are the conditions for the demerger? The conditions for the demerger are given under the conditions to be fulfilled are given under section 219AA. Section 219AA of the Income Tax Act provides for the condition. Now, what are the conditions? Let's see. So it says, I'll put it here so that you are able to see it. See. Demerger in relation to companies means the pursuant to a scheme of arrangement by a demerged company of one of its one or more undertakings. What is the meaning of undertaking? Undertaking is also defined in the explanation. So undertaking means, or undertaking shall include this. Undertaking shall include any part of an undertaking or a unit or division of an undertaking or business activity taken as a whole, but does not include individual assets or liabilities. Okay. So in relation, demerger in relation to company means for transfer of one or more undertakings to any resulting company in such a manner that all the property of the undertaking being transferred by the demerged company immediately before the demerger becomes the property of the resulting company. All the liabilities relatable to the undertaking being transferred by the demerged company before the demerger become the liabilities of the resulting company. The property and liabilities of the undertaking being transferred by the demerged company are transferred at the values appearing in its books of account. Meaning, this should be at book value. So assets and liabilities are to be transferred at book value, ignoring the revaluation. right? So the asset and liability to be transferred are at the book value shall not be applicable. Sorry, book value, and this means the revaluation shall not be applicable. Okay. 1 second. Okay. The provisions of the book value, transfer at the book value, will not be applicable where the resulting company records the value of the property and liabilities of the undertaking at different than the book values immediately before the demerger in compliance with the Ind AS. So where the resulting company is recording the values at other than the book value, in compliance with the Ind AS, then this clause will not be applicable. The resulting company issues in consideration of the demerger, its shares to the shareholders of the demerged company on a proportionate basis, except where the resulting company itself is a shareholder of the demerged company. So let's say if this is the holding company, this is the subsidiary company. Now subsidiary company transfers, say, unit A to the holding company. Subsidiary company transfers the unit A to the holding company. Correct? Now subsidiary company can issue the shares. Can it issue the shares to the shareholders of the holding company? The answer is yes. The answer is yes. But let's say if we reverse this scenario, if I make this as the subsidiary company and the holding company now transfers unit A to subsidiary. If the holding company transfers the unit A to the subsidiary company, then can holding company issue the shares to itself? Answer is no. Holding company cannot issue the shares because who are the shareholders of ESCO? HCO. Who is the resulting company? ESCO. Sorry, who is the resulting company? The HCO. So then in that particular case, 1 second, this has to be also reversed. ESCO is transferring the unit A to HCO. Now, can HCO issue the shares to itself? Answer is no. So where the resulting company itself is a shareholder of the demerged company, the holding company itself is the shareholder of the demerged company. So ESCO's shares are held by HCO. HCO is the resulting company. Now will HCO itself issue the shares to the ESCO? Answer is no. The shareholders of ESCO? Answer is no. So where the resulting company itself is a shareholder of the demerged company, then this condition will not be applicable. The shareholders holding not less than 3/4 in value of the shares in demerged company, meaning 75% of the shares in the demerged company, other than the shares held before the demerger or by a nominee for the resulting company or its subsidiary, become shareholders of the resulting company. So more than 75% of the shareholders should become the shareholders of the resulting company. Clear? Okay. The transfer of the undertaking is on a going concern basis. The demerger is in accordance with the conditions notified by the central government. Okay. So these are the conditions to be fulfilled. These are the conditions to be fulfilled. Okay. Now, one more thing over here. There are some other demergers which are also exempt. What are those? (47) 6C or 47(6)cc. These are the two clauses which are applicable for the demerger, which is transfer of shares held in Indian company or a foreign company, transfer of shares held in the Indian company, shares held in Indian company. So what is the capital asset which is getting transferred? The shares held in the Indian company. So here, let me just give you an example and then write. That will be better. Let's say if one foreign company, if a foreign company transfers or demerges, if a foreign company demerges, and in that demerger, the shares held in Indian company are transferred. Any transfer in a demerger of a capital asset, if this company is demerging into another foreign company, into another foreign company, then in that particular case, if the underlying asset as a part of demerger is the shares of Indian company, so then in that case, that is also considered as the exempt transfer. Exempt under section 47(6). So any transfer in a demerger of a capital asset being a share of the Indian company by the demerged foreign company to the resulting foreign company. And what are the conditions over here? Shareholders greater than 75% of demerged foreign company become shareholders of resulting company, right? These are the conditions, and such transfer should not attract any capital gain tax in the country of demerged company. Clear? Are we clear? Then 47(cc), 47(cc), which is in the context of any transfer in a demerger. Of a foreign company, right, to another foreign company. So here also there is a demerger. So any transfer in a demerger where a capital asset which is transferred is share of a foreign company. Here, share of a foreign company gets transferred. But this particular share of foreign company derives value substantially from the shares of Indian company, which is an indirect transfer provision which you will learn in international tax class. So that also will be considered as exempt transfer under section 47(6)cc. Conditions again remain the same. What are the conditions? These two. Sorry. The conditions remain the same. Shareholders greater than 75% of the demerged foreign company become shareholders of the resulting company. Such transfers should not attract the capital gain tax in the country where the demerged foreign company is incorporated. Clear? Any doubt? Clear? So all these demergers are exempt. Right? Now here, what is the cost of acquisition? What is the cost of acquisition? That is the important point over here. Cost of acquisition of the shares of demerged company and resulting company. So section 49(2)(c) talks about the cost of acquisition of shares of resulting company and how it has to be derived. It is cost of shares of demerged company into net book value of assets transferred to resulting company divided by net worth of demerged company. Net book value of assets transferred to the resulting company divided by net worth of the demerged company. Are we clear? Then cost of acquisition of the shares. Okay, 1 second. Net book value of the assets transferred to resulting company divided by net worth of demerged company. What is net worth? Net worth is equal to paid up share capital plus general reserves, right, as appearing in books of accounts of demerged company before demerger. If net worth is negative, cost of acquisition is nil. Clear? If net worth is acquisition, cost of acquisition is nil. 49(2)(d) is cost of shares of demerged company. Right? When I'm selling off the shares of the resulting or the demerged company, how will I calculate the cost of the acquisition of the shares in resulting company? This will be the cost of shares of demerged company into net book value of assets transferred to the resulting company by the demerged company divided by net worth of demerged company. Net worth is paid up share capital plus general reserve. What is the cost of shares of the demerged company? It is cost of shares of demerged company minus cost of shares of resulting company. So you will reduce this cost here to get the cost of the shares of demerged company. Clear? What will be the period of holding here? Period of holding for the shares of the resulting company as per explanation 1 to section 242A will include period of holding of shares of demerged company. Indexation, again, Manjula Shah judgment applicable. Right? So indexation will also be from the earlier period. Clear? Are we clear? Any doubt? So is demerger clear? Okay. Any questions? Any doubt? Conversion means that the holding company cannot be shareholders of the resulting company. Oh, condition 4. Yes, holding company can be the shareholders of the resulting company, but they cannot issue the shares to themselves. I mean, see, I'm a holding company, I'm the resulting company, right? So if I am the holding company of my subsidiary company, how can I issue shares to myself? So that condition will not be applicable then, because the resulting company should issue the shares, right? So that's the point. Okay. Last one point in the demerger, that is relating to PGBP, but I'm just trying to link over here that WDV of the demerged company, WDV of the demerged company will be WDV of the block of assets as on 1st April, right? Less WDV of assets transferred to the resulting company, right? So this will be the WDV. And what will be the actual cost in the hands of resulting company? So the actual cost will be as in the hands of demerged company, which is the WDV, right? Depreciation will be allowed proportionately over number of days assets used, right? So depreciation will be allowed proportionately. Are we clear? Okay. Okay, so let's take a small break, and after the break, we are going to deal with two more things: amalgamation and slump sale. Clear? Okay, let's take a small break of 10 minutes and then we get back. Okay. So let's start with amalgamation. Amalgamation. Okay. Now, under the amalgamation, so it is more or less like demerger, but in fact, much simpler than the demerger part. So let's try and understand now the amalgamation. Company A will merge with company B. That is the amalgamation, right? So if a capital asset which is transferred by A to B in the process of amalgamation, B will issue the shares to the shareholders of the amalgamating company. So amalgamated company will issue the shares to the shareholders of the amalgamating company, right? So amalgamating company will transfer the capital assets to the amalgamated company, and in consideration of that, the amalgamated company will transfer the shares to the shareholders of the amalgamating company. Now this is considered as exempt transfer under section 47, similar to demerger, right? So this is considered as exempt transfer under the under 47(6), provided that the amalgamated company is an Indian company. Okay. Now, if there is any transfer of the shares by the amalgamated company to the shareholders of the amalgamating company, then in that particular case also, that is also considered as exempt transfer. Are we clear? So the amalgamating company will transfer the capital asset to the amalgamated company, correct? And the amalgamated company will transfer the shares to the amalgamated company. So any transfer by a shareholder in a scheme of amalgamation of a capital asset being the shares of the amalgamating company. So here the shareholder is holding the shares of the amalgamating company, which is getting amalgamated with the amalgamated company. So therefore, the transfer by the shareholder's rights are getting extinguished, right? He will not hold the shares of the amalgamating company. Now he will hold the shares of the amalgamated company. So if he receives the shares of the amalgamated company, then that is also considered as exempt transfer. So transfer of capital asset of being shares in amalgamating company, then this is considered for shares in amalgamated company exempt under section 47(7). Condition remains the same, that the amalgamated company is an Indian company. Are we clear? Right? If he receives the cash, if transfer of a capital asset being shares of amalgamating company for cash, if he receives cash, so this he is receiving shares, and if he receives the cash, let me just remove this, then it's the same thing what I'm writing. Okay, for cash, then your full value of consideration will be the cash received. Cost of acquisition will be the cost of shares. Period of holding and indexation will be the period of holding in A. And indexation will also be for this period. So if he receives the shares, then it is exempt. So if he transfers, so if his right is getting extinguished, right? If his shares in amalgamating company is transferred due to amalgamation and he receives the shares of the amalgamated company in consideration, that is considered as exempt transfer. Otherwise, if it is cash, then that is not considered as the exempt. Clear? Now, what is the condition for this? Transfer of capital asset by the amalgamating company to the amalgamated company. So this is considered as the exempt transfer, as I said, under section 47. Now, amalgamation also, like demerger, has the exemptions. And what are the exemptions? So amalgamation is defined under section 2(1)(b). It means the merger of one or more companies. Let me write the definition over here for your purpose. These are the conditions as well. Yes. Amalgamation means the merger of one or more companies with another company, or merger of two or more companies to form one company. All the property of the amalgamating company immediately before the amalgamation becomes the property of the amalgamated company. All the liabilities of the amalgamating company before the amalgamation become the liabilities of amalgamated company. Shareholders holding not less than 3/4 in value of the shares in the amalgamating company become the shareholders of the amalgamated company. Are we clear? Are we clear? So these are the conditions to be satisfied. Clear? Any doubt? These are the conditions to be satisfied. Now, what is the cost of acquisition of shares? Cost of acquisition of shares of amalgamated company. This is not like demerger. In demerger, you have cost of acquisition of the demerged company into the net asset value divided by net worth, right? Here, the cost of acquisition will be the cost of the acquisition of the shares of the amalgamating company. Period of holding of shares. Period of holding of shares of amalgamated company will be including the period of holding of shares of amalgamating company. This is explanation 1 to section 242A. And indexation will also include this period, meaning Manjula Shah judgment applicable. Clear? Are we clear? Any doubt? Okay. What are the other amalgamations which are exempt? So other amalgamation which are exempt, like we saw in the case of demerger, similarly here also we have it in the case of the amalgamation. So transfer of a capital asset under 47 6A and 6AB. Under 47 6A and 6AB, same thing. If, let's say, for example, foreign company is getting amalgamated with another foreign company, and the shares are, and the capital asset which is being transferred is shares of Indian company, or if a foreign company is amalgamated with another foreign company and the capital asset are shares of foreign company which are being transferred, which derive their value substantially from shares of Indian company. Right? So this is indirect transfer provision. These are exempt under 47(6)(a) and 6(b). The conditions for both of them are more than 25% of the shareholders of amalgamating company must be shareholders of amalgamated company, and transfer should not attract capital gain tax in the country of amalgamating company. Are we clear? Are we clear? Okay. What are the other type of amalgamation which are exempt? So 47(6)(a). 47(6)(a). What does it provide? I'm just putting it on the screen, not writing it. This is amalgamation of a banking company with a banking institution. That is also exempt. Let me just put it like this. One second. Okay. Yes. 47(6)(a). Amalgamation of banking company, and that is also exempt. That is also considered as exempt. Okay. Clear? Now some additional points with regard to the amalgamation, which is not in relation to the capital gain chapter, but I'm covering it comprehensively for you so that you remember these things. Again, for the depreciable asset, the WDV will be the same. So WDV of block of assets for amalgamated company will be WDV of amalgamating company. So in the hands of the amalgamating company, there would be nothing because it is amalgamated. In the hands of the demerged company, the demerged company was still existing. So therefore, what we did is block of assets less WDV of assets transferred in resulting company. And same was the case in the case of determining the cost of shares. Since the demerged company is not becoming non-existent, amalgamated company becomes non-existent after amalgamation, right? So in the case of demerger, the cost of acquisition of the shares of the demerged company is to be determined, of the resulting company is to be determined, and then that has to be reduced from the cost of acquisition of the demerged company to arrive at the cost of the shares of demerged company. Clear? Whereas in the hands of the, in the case of the amalgamating company, the cost of acquisition of the amalgamated company's share is the cost of acquisition of the shares of amalgamated company. Clear? Same is with the depreciable asset. Depreciation will be a portion, again, proportionately on the basis of assets used, on the basis of number of days for which assets used. Clear? Are we clear? Cost of acquisition of any other asset for amalgamated company, non-depreciable asset, that is the cost to the amalgamating company. Clear? Period of holding, again, that will be clubbed. Indexation, again, Manjula Shah applicable. Clear? This is for the, let me do this thing. One second. It's becoming messier, so I'm just writing it down. This is for non-depreciable asset. Cost of acquisition to amalgamated company is equal to cost to amalgamating company. Clear? Are we clear? Then, with respect to the carry forward and set off of the losses, which is now I'm talking both about the amalgamation and in the case of demerger. In the case of amalgamation, the losses of amalgamating company can be carry forward and set off by amalgamated company for fresh period of 8 years. For the fresh period of 8 years. And what are the conditions here? Conditions are that the amalgamating company should be industrial undertaking or a shipping company or, shipping company, amalgamated company, amalgamated company is banking company or aircraft. So it's an industrial undertaking, the amalgamating company, and the amalgamated company can be a banking company, shipping company, aircraft, or hotel. Right? Or a banking company. So, sorry, this is the same only. Banking company or aircraft or hotel. Right? So where there has been amalgamation of any industrial undertaking company, ship, hotel, or a banking company, then in that case, the losses can be carried forward and set off by the amalgamated company. What are the other additional conditions? At least, what are the conditions? 3/4 of value of fixed assets. At least 3/4 of the value of the fixed assets has been held for minimum period of 5 years of amalgamating company held for 5 years. These are the conditions for amalgamated company. Conditions for amalgamated company. Condition 1. What is the second condition? continues the business of the amalgamating company for 5 years. Continues business of amalgamating company for 5 years. And the last condition is that the business of the amalgamation is basically for genuine business purpose. Amalgamation for genuine business purpose. So losses of amalgamating company can be carried forward and set off by the amalgamated company for a fresh period of 8 years. Which are the companies? Amalgamating company can be industrial undertaking, shipping, banking, hotel, aircraft, and at least 3/4 of the value of the assets of the amalgamating company held for a period of 5 years. Continues the business of amalgamating company for 5 years. Amalgamation for genuine business purpose. Clear? These are the conditions for the amalgamated company. These are the conditions for the amalgamated company, right? Then conditions for the amalgamating company. There are conditions for both. What are the conditions for the amalgamating company? Engaged in business for 3 years or more, or greater than equal to 3 years, and holds at least 3/4 of the value of fixed assets, for 2 years prior to amalgamation. So the losses of the amalgamating company can be carried forward and set off by the amalgamated company for a fresh period of 8 years. The amalgamating company, the conditions for that are that it should have been engaged in business for greater than equal to 3 years. It holds at least 3/4 of the value of fixed assets for 2 years prior to amalgamation. For amalgamated company, the condition is at least 3/4 of the value of fixed assets of amalgamating company had to be held for 5 years. Continues the business of amalgamating company for 5 years. Amalgamation for genuine business purpose. If these conditions are satisfied, the amalgamated company can carry forward the losses of the amalgamating company. Clear? So these conditions are there so that the amalgamation is not a sham amalgamation. Clear? No, in case the nature of the business changes, then the losses will not be allowed. So if you violate any of these conditions, then the losses will be, you can write it down here, violation of any condition by amalgamated company or amalgamating company, then in that particular case, losses or unabsorbed depreciation allowed shall be deemed to be income of amalgamated company in the previous year of non-compliance of conditions. Clear? So if the conditions are not complied, it will be treated as deemed income. Now, similarly, for the demerger also, we have the unabsorbed depreciation and losses allowed for the resulting companies undertaking to the demerged companies undertaking to the resulting company. So in case of demerger, accumulated loss and unabsorbed depreciation, which is relatable to the undertaking, transferred will be allowed to be carried forward and set off by the resulting company. So, write it over here. Losses and unabsorbed depreciation of demerged undertaking can be carried forward and set off by a resulting company, but this is for balance years and not for fresh 8 years. So amalgamation, the amalgamated company gets fresh 8 years because it carries forward the business. Here you will only get the balance years because here you are just taking over the unit. Okay? Clear? Are we clear? Now, few other points which I would just tell you, maybe you can remember. This is applicable for both demerger and amalgamation. So, expenditure on amalgamation or demerger, if you remember, under PGBP, we had seen the deduction under section 35DD 1/5 every year, right? 1/5 every year. Then deduction under section 36(1)(7) of bad debts allowed to the resulting company. Bad debts if income of predecessor. Remember, we have all done this, but I'm just recapping for you. Then clear? Are we clear? So I'm just recapping everything for you. Vinay, if capital asset is brought by shareholder and in lieu of consideration additional shares issued to, how a shareholder will put the asset? This is a company. So shareholder will transfer the asset. That will be considered as transfer only. This is not a partnership, Vinay. Okay. Now the last one, slump sale. Next is the slump sale. Okay. Now this is very, very important because here recently the amendment has been made. Now what is slump sale? Let's try and understand. This is under section 50B. The computation is under 50B, but slump sale is defined under 242C. Now what does 242C define slump sale as? Section 242C defines slump sale as where the assets are transferred or an undertaking is transferred for a lump sum consideration without assigning the values to it, individual values to it. I'm just copying here for your purpose. Slump sale means, if you see, transfer of one or more undertaking by any means for a lump sum consideration without values being assigned to the individual assets and liabilities in such transfer. So slump sale means transfer of one or more undertakings by any means for a lump sum consideration without values being assigned to the individual assets and liabilities. Right? Now, how does this slump sale happen? Let's say I have a company A. I have 2 units. Unit 1, Unit 2. Now here I'm not demerging the Unit 2. I'm not demerging the Unit 2. I'm just transferring for a lump sum consideration. Demerger is different. Demerger has to be in accordance with 219AA, where the shareholders are being same, more than 3/4 of the value of the shareholders are same, assets are transferred at the book value, so liabilities are transferred, all the assets are transferred. That is different. Here I am selling off the unit 2 for lump sum consideration instead of selling all assets and liabilities and individual value. Clear? So this unit is transferred for lump sum consideration. For lump sum consideration. Are we clear? Then, what is the period of holding over here? Here, the period of holding is for undertaking greater than 36 months, it will be LTCG. For less than equal to 36 months, it will be STCG. Clear? Computation, as I said, is under 50B. Computation is under 50B. Computation is full value of consideration minus cost of acquisition. Here, you will not have any indexation. So, no indexation. Here, you do not have any indexation. Now, what is my full value of consideration? FMV1, FMV2, higher of this. Earlier, it never used to be this way, but now it has been amended. So what is FMV1? A plus B plus C plus D minus L. What is A? A is the other assets. A is the other assets. So I will tell you how it works. So if you will go to section 50CA, if you will go to section 50CA, which we are going to deal with it, it's not that we are not going to deal with it. So there also you will find a similar provision for the purpose of valuation of shares. For the purpose of valuation of shares. Here also we have the similar provision. So A is the book value of the other assets. A is book value of any other asset other than what we are going to see in B, C, D, E, right? Minus income tax paid, minus income tax paid, minus unamortized deferred expense, unamortized deferred expense plus income tax refund, plus income tax refund. B is the value of the price of the jewelry and artistic work. So B is for the jewelry and artistic work, the open market value. Open market value, right? On the basis of valuation report. Based on valuation report. Clear? C is the value of shares and securities. Shares and securities value as per rule 11UA. Value as per rule 11UA. 11UA we are going to deal in refer section 50CA. You can write it here. We are going to deal there. As well as 56 to 10 in income from other sources. Clear? D is value of immovable property, which is 50C, stamp duty value, which is the stamp duty value, which you will also see in 50C. L is liabilities. So A is book value of any other asset, B is jewelry and artistic work, which is the open market value, C is securities and shares, which is as per 11 UA, D is immovable property, which is stamp duty value, and L is liabilities. Now liabilities, again, it is book value of liabilities, book value of liability less paid up share capital of equity shares, reserves and surplus except for depreciation, reserves and surplus except for depreciation, except for those set aside for depreciation, less provision for tax, less provision for tax other than the income tax paid, undeclared dividend and contingent liabilities, undeclared dividend, contingent liabilities, then provision for unascertained liabilities, less provision for unascertained liabilities. Clear? What is my FMV2? This is my FMV1. FMV2 is monetary consideration plus non-monetary consideration. Monetary plus non-monetary consideration. Now, what is my monetary consideration? E plus F plus G plus H. So, E is my monetary consideration. E is the value of the money received. F is the fair market value of the non-monetary consideration. So, E is monetary amount, monetary consideration. F is value of the fair market value of the non-monetary consideration, which is received, which is shares. So, value of shares, fair market value of shares as per rule 11 UA. As per rule 11 UA. G is again jewelry and artistic work, which is open market value. Open market value as per valuation report. And H is immovable property, which is STV. So the difference between FMV1 and FMV2 is nothing but in FMV2, we have the additional monetary consideration, which is not in FMV1. So in case you receive cash, then you will have FMV2 also. Clear? And in FMV2, we are not reducing the book value of liabilities, whereas in FMV1, we are doing that. So whichever is higher will be taken up. This is my full value of consideration. What is my cost of acquisition? Cost of acquisition here is net worth. Net worth, which is book value of total assets. Book value of total assets. Ignore revaluation. For depreciable assets, it will be WDV. For self-generated assets, it will be nil. And for capital assets on which deduction is claimed or deduction is allowed, again that will be nil. Example 35 AD. Are we clear? Less book value of liabilities. So book value of assets minus book value of liabilities. This is how we calculate the slump sale. Are we clear? Shall we solve a question on this? So whenever the capital asset is transferred in March and the consideration, which is a share allotted in April, it is obviously in the year of transfer. As per section 45(1), the transfer, when it is taking place, the capital gain will arise. Clear, Vinay? Shall we solve a question on this? Shall we? Yes or no? Are we clear? Okay. If you are clear, then let's solve a question on this from your module. We are going to solve a question on this from your module. Let me open up your module. There's a question on that on page 7.86. 7.86. You are going to solve this question and then I'm going to give you the answer. Illustration 12. Illustration 12. Are you able to see this? Measures Shriram Enterprises, a proprietorship having 2 units. Unit 1 is transferred on 1/4/21 by way of slump sale for a total consideration of 14 lakhs. Unit 1 was started in the year 5-6. The expenses incurred for this transfer were 38,000. Balance sheet as on 31st March 2021 is as under. Unit 1 and Unit 2, the liabilities are given: own capital, revaluation reserve for building, bank loan, trade creditors, asset side, building, machinery, data, and patent. Revaluation reserve is created by revising upward the value of building of Unit 1. The stamp duty value on 1/4/21 is rupees 10 lakhs. No individual value of any asset is considered in the transfer deed. Patents were acquired on 1/7/2019 on which no depreciation has been charged. Compute the capital gain for AY 22-23. So yes, you are required to do that. I'm giving you 10 minutes time. हेलो, मैंने क्वेश्चन सॉल्व करने दिया है। Jacob, paid up share capital will include everything, preference, equity, all. Are you done with it? Shall we solve together? What are your answers? Okay, what is the fair market value 1? What is the fair market value 1? What are you taking into it? Building, what amount are we taking? Tell me one by one. What is the fair market value 1? Or tell me what is the building amount you have taken? 10 lakh. Yes, Vinay Kumar, correct. So you will take the stamp duty value of the building, which is 10 lakh, correct? Then machinery, what is the amount you have taken? Machinery, what is the amount we have taken? Yes, Jacob, SDV. 4 lakh, Vinay Kumar, correct. Then debtors, what is the amount we have taken for debtors? Yes, Jacob, correct, 4 lakh. Debtors, what we have taken? 2 lakh, Vinay. Yes, correct. Debtors is 2 lakh. Patents, what is the patents we have taken? $2.5 lakh, correct. So book value of all the other assets, machinery, debtors, patents, we have taken the book values only, right? Which is the A. Stamp duty value we have taken of the immovable property, right? There is no other asset. Then book value of the liabilities. So in that case, what we are considering first, whether you have considered the trade creditors, how much of the trade creditors you have considered? Trade creditors. Yes, Vinay, give me the amount. Jacob, what is the amount of trade creditors? What is the amount? Trade creditors, what is the amount? Yeah, that's correct. Correct, Vinay. Correct, Jacob. 87,500. Bank loan, whatever you've taken for the bank loan. Bank loan, how much we have taken? Yes, Vinay, yes, correct. 2.8 lakh because 70% of 4 lakh. Correct. Then revaluation reserve is to be taken or not? 5 lakh. Revaluation reserve of 5 lakh to be taken or not? Revaluation reserve is to be taken or not? No, that's not the correct answer, Vinay. Revaluation reserve has to be ignored. So if you see here, what did I say? Liabilities, book value of all the liability, less paid up share capital of equity shares, less any reserves and surplus. So revaluation reserve has to be ignored. Clear? Revaluation reserve has to be ignored. What about the own capital? What about own capital? What about own capital? Yes, but here if you see, revaluation reserve is created by revising upward the value of the building. So here it is not for the depreciation, it is a revaluation reserve. So that has to be ignored. That has to be ignored, Vinay. What about paid up share capital? Amit Kumar, it cannot be. See on the screen. What does it say? Book value of liability, less paid up share capital, less reserves and surplus. So how will you include in FMV1? You can't. Clear, Amit? What about the paid up share capital? What about the paid up share capital? Not to be taken. Yes, Vinay. Jacob, not to be taken. Correct. So I'll just share the screen to show you how the computation has arrived here. So if you see here, so my fair market value has included building 10 lakh, stamp duty value, machinery 4 lakh, daters 2 lakh, patents 2 lakh 50, 18 lakh 50, less book value of liability 29 lakh 50,000. Total value is taken, out of which the unit 2's bank loan and trade creditors are removed. So only one remains is unit 1. What we have done is we have included unit 1, excluding own capital 17 lakh and revaluation reserve 5 lakh. So fair market value of capital asset transferred by way of slump sale FMV1 comes to 14 lakh 82,500. What is FMV2? Very easy. What is FMV2? What is my FMV2? What is my FMV2? 14 lakh. Yes, Checo. My FMV2 is 14 lakh. Only monetary consideration is received I have not received any non-monetary consideration. So 14 lakh or 14 lakh 82,500. Higher one is 14 lakh 82,500. Now comes the net worth. So what will be your net worth? What is net worth? Tell me very quickly now. You should be able to give me the direct answer for the net worth. What is the net worth? What is the value of the net worth? Very quickly tell me. 2 minutes time. Tell me the net worth figure. No, Jacob, that's not the correct answer. Okay, tell me what is the building you have taken in the net worth? What is the value of building you have taken in the net worth? No, Vinay. What is the value of building we have taken? No. Vinay, what did I say here? Let's go back to our notes. Book value of total assets. Ignore revaluation. So in the building of 13 lakh, there is a revaluation which has been there by 5 lakhs. Isn't it? So if you see here, in the building of 13 lakh, there is a revaluation of 5 lakh. So therefore, here, if you see, my building is only 8 lakhs and not 13 lakhs. So now, wherever you are writing your notes, put a big red mark, write it down in red so that you don't make the mistake in exam. Ignore revaluation. Write it in red just now. Ignore revaluation. Right? Yes, Amit, it is 8 lakh. Correct. No, Jacob, not 21.5. No, Vinay, it will not be 10 lakh. It is book value, but we have to ignore revaluation. So, we have to ignore revaluation. So, 8 lakh. Clear, Vinod? Sorry, clear, Vinay? Okay. What is the machinery you have taken? Value of machinery for the purpose of net worth? Machinery for the purpose of net worth, 4 lakh. Correct. Machinery is 4 lakh. Then debtors. Debtors. Data fast. 2 lakh. Clear. Patents, Vinay, again a mistake. 2.5 lakh you have taken. What did I say over here? Book value of total assets. For depreciable assets, take what? WDV. Again, write it in a red point. Write it with a red pen in your book. For depreciable assets, even if your balance sheet consists of the book value without depreciation, you have to take WDV. What is the adjustment written over here? The adjustment written over here is no patents were acquired on 1/7/19 for which no depreciation has been charged. So you need to take written down value and not the book value for depreciable asset. This is how the exam questions will come. Yes, Amit, correct. Very good. So it shouldn't happen that you are writing and then you feel you have written right, but it could be wrong. Even MCQs can come like this. Are we clear? Jacob, did you understand why not 2.5 lakh? So how will you calculate what is the depreciation rate on patent? What is the amount of patent you will take? Now finally tell me the right answer. Patent figure. Fast, fast, fast. Patent figure. Patent figure fast. One final amount, but this should be right by all of you. Vinay, the balance sheet is correct. But we need to take the written down value. Balance sheet is telling, so it's correct now. Patent value fast. Yes, Vinay. It is 1,40,625. Depreciation at the rate of 25% for financial year 1920. Then for financial year 2021, WDV is 146.25. Are we clear? Are we clear? Even for machinery and building, see, they have written a note. The problem has been solved assuming that the balance sheet value of 4 lakh and 8 lakh represent the written down value of machinery and building respectively of unit 1. Are we clear? Clear? Okay. Then book value of liabilities, that is simple. 4 lakh, 70% of that, and 3 lakh 50, 25% of that, which comes to 87,500 and 2 lakh 80, which is what we saw. You reduce it down, this will give you net worth of 11 lakh 73,125. Now, what we will do is fair value of consideration, full value of consideration is your fair market value, 14 lakh 82,500. Less expenses on transfer. Do not forget that after solving a complex question, you will make a small mistake. The expenses incurred for this transfer are 38,000. So expenses on transfer 38,000, net sale consideration 14 lakh 44,500, less net worth of 11 lakh 73,125. Now the unit 1 was transferred in on 1/4/21, but it was started in 5/6. So this is a long-term capital gain of 2,71,375. What is the tax rate on long-term capital gain? What is the tax rate? Quickly. Yes, Jacob, correct. It's 20%, but no indexation, STCG, normal rates. Clear? Are we clear? Yes or no? Okay. Okay. Last one thing before we close the session, I would cover 2-3 important points and then we'll close and then we'll do it in the next class. Okay. So let's see this thing. One second. conversion of sole proprietary concern into company, number one. Number two, conversion of partnership firm into company. And number three, conversion of unlisted company to LLP. All three are exempt. All three are exempt. Right? So conversion of sole proprietary to the company is also exempt. So I'll take it up from the module only so that, these are just conditions, but we'll just do it from module. Okay. See, 47.14. Transfer of a capital asset or intangible asset by a sole proprietary concern to a company on succession of the sole proprietary concern by the company. All the assets, there is a condition there, all the assets and liabilities of the sole proprietary concern relating to the business immediately before the succession should become the assets and liabilities of the company. The sole proprietor should hold not less than 50% of the total voting power in the company, and its shareholding should continue in such manner for a period of 5 years from the date of succession. Sole proprietor should not receive any consideration or benefit in any form directly or indirectly other than by way of allotment of shares in the company. So this is the conversion of the sole proprietary into the company. Next is conversion of partnership firm into company. So again, in the case of the partnership firm, transfer of a capital asset or intangible asset by a firm to a company on succession of the firm by company in the business carried on by the firm, or transfer of capital asset by AOP or BOI to a stock exchange due to corporatization and demutualization that we have covered. So for the firm to the company, what are the conditions? Let's see here. See, transfer of capital asset or intangible asset on succession of firm by a company. Condition are all the assets and liabilities of the firm relating to the business immediately before the succession becomes the assets and liability of company. All the partners of the firm immediately before the succession become the shareholders of the company in the same proportion in which their capital account stood in the books of the firm on the date of succession. Partners of the firm do not receive any consideration or benefit in any form directly or indirectly other than by way of allotment of shares in the company. Partners of the firm together hold not less than 50% of the total voting power in the company, and their shareholding continues in such manner for a period of 5 years from the date of succession. Clear? Then transfer of capital asset or intangible asset by private company and share held by shareholder to LLP in a conversion of a private company into LLP. So conversion of private company or unlisted company to LLP, any transfer of a capital asset by a private or unlisted public company to LLP, or any transfer of shares held in a company by a shareholder on conversion of company into LLP is again exempt. So it is exempt for both for the shareholders of the company as well as for the capital assets which are transferred by the company to the LLP. So one transfer is company transferring capital asset to LLP. Secondly, the shares of the company are also getting extinguished. So there's transfer of the shares by the shareholders. In consideration, they are receiving the LLP interest. So what are the conditions? All the assets and liabilities of the company immediately before the conversion become the assets and liabilities of the LLP. All the shareholders of the company immediately before the conversion becomes the partners of the LLP, and the capital contribution and profit sharing ratio in the LLP are in the same proportion as their shareholding in the company on the date of conversion. No consideration other than share in profit and capital contribution in LLP arises to the shareholder. The erstwhile shareholders of the company continue to be entitled to receive at least 50% of the profits of the LLP for a period of 5 years from the date of conversion. Here, there are two additional conditions which were not there for sole proprietary and partnership conversion. Total sales, turnover or gross receipts in the business of the company should not exceed rupees 60 lakhs in any of the 3 preceding previous years. you don't have to calculate 60 years on an average in 3 years, but in all the 3 years, the condition of 60 lakh should not be breached. So in all the 3 years, the turnover should be lesser than 60 lakh. If in any 1 year the turnover exceeds 60 lakh, the condition is violated. The total value of assets as appearing in the books of the accounts of the company in case of the 3 preceding previous years in which the conversion takes place should not exceed 5 CR. Again, this is to be applied in each year and not on aggregate basis. No amount is paid either directly or indirectly to any partner out of the accumulated profit of the company for a period of 3 years from the date of conversion. Are we clear? Are we clear? So this is the conversion of the LLP to the company. Sorry, the conversion of the company to the LLP. And in case where any of the conditions are not complied with, in this particular case, so where any of the condition under 13 or under 14 of section 47 or for this 13B are not complied with, then the amount of profits or gains arising from the transfer of the capital asset, which is the exemption which is granted to the sole proprietary or to the partnership firm, which that exemption shall be revoked. So where any of the conditions for the partnership or sole proprietary are not complied with, then the capital gains which is there, which is being exempted, shall be deemed to be the profit and gains of the successor company for the previous year in which the conditions are violated. Similarly, in case of the company transferring the capital asset to LLP, if the conditions of 4713B are not complied with, then the capital gains which is arising shall be deemed to be the profit and gains of the successor LLP or the shareholders of the company in the year in which the conditions are not complied with. So for the firm and the sole proprietary, it will be the capital gains of the successor company. But for LLP, it can also be the capital gain of the shareholders or the LLP, as the case may be. Clear? Again here, one more important thing, just linking it to PGBP again. Depreciation in all of these cases will be allowed on the proportionate basis. So aggregate amount of depreciation will be allowed on the basis of the number of days for which the assets are used by each of them. Clear? Are we clear? Then accumulated losses of the partnership or of the sole proprietary will be available to the company. Similarly, the brought forward losses and unabsorbed depreciation of the company will be allowed to the LLP. If the conditions are violated, then the loss will be deemed to be the income of the successor LLP or the successor company. Cost of acquisition of the asset, cost of acquisition of the capital asset for all of these will be deemed to be the cost to the previous owner, and it will be even the period of holding will be clubbed and indexation benefit will also be allowed. Are we clear? Are we clear? Similarly, for the shares of the, in the case of the shareholders of the company, where the company is being converted to LLP. So the cost of acquisition of the LLP interest will be the cost of acquisition of the shares in the company. Clear? Any doubt? Cryptocurrency, we will deal it later, Jacob. Yes, you will charge the depreciation then. Any other question? Okay. Okay, so thank you so much. I want you to revise. And in the next class, we will do the computation and the 54 series before we get into the income from other sources. Vinay, net worth from the bare text ones. Okay, 50B section, if you want me to interpret it, I have interpreted from bare text only, but again, for your purpose, the net worth will be the cost of acquisition. Now, the net worth means the aggregate value of total assets as reduced by the liabilities, and the revaluation shall be ignored. Also, it says, okay, let me just, put it for you on the screen so that, you can refer. The bare text is the same. See. Net worth shall be the aggregate value of total assets of the undertaking as reduced by liabilities, ignoring the revaluation. For the purpose of computing net worth, depreciable assets, written down value, goodwill, nil, and 35 AD, again nil. Clear, Vinay? All right. Thank you so much. See you in the next class. 1 second. Vinay, you have doubt. Net worth of the undertaking as the case may be shall be deemed to be the cost of acquisition and cost of improvement. Yeah, so what is problem in that? Net worth shall be deemed to be the cost of acquisition and no indexation will be given. Jacob, I'm not sure whether the time will permit, but of course, see, whatever important things were there, we have done that. I would suggest you that you solve, and in case you have any question, we can discuss that. I don't think the time will permit to solve the questions on capital gain. Okay. Thank you so much. See you in the next class.